Today's topic, I want to discuss financial planning and how to leverage financial planning effectively, whether you're in a pre-retirement stage and you're trying to accumulate your dollars as much as possible to get to a specific goal, or if you start nearing your retirement stage right before you're about to retire, and then how do you leverage those accumulated assets to splice them up to make sure that it's producing the proper cash flow for you to accomplish your expenses or to accomplish your goals and suffice your expenses throughout retirement. So I'm going to go through the common mistakes that individuals make, how to avoid those common mistakes, and ultimately just put your mind at ease to let you know that financial planning isn't really that complicated. It's just making sure that you're taking consistent measurements that will pertain to your specific goal, and you're just using time, you're using compound interest, and you're making sure that you're pinpointing, how to accomplish those goals with using the correct tools or the correct accounts to do so. So the first bullet point talks about starting point. When do you want to start planning for your retirement or for a specific financial goal? Do you want to do that now? Do you want to wait till January 1st? Do you want to wait a couple years from now and just kind of have fun with any of your excess monies? What exactly is that planning stage? Typically, when individuals call the agency, they're trying to set up a plan for today or for 10 years ago because they said, I unfortunately didn't take the time to do this. I'm a little bit late to the game and I want to make sure that I'm doing this effectively. So we want to figure out what this person's age is and then also what is their ideal retirement date. So each individual situation is going to be different. We could be dealing with clients in their 30s, let's say a client that's age 35 that wants to retire exactly at age 65, or we could be dealing with somebody that's, let's say, age 42 that wants to retire exactly at age 55. So each individual is different. Or obviously, you could have some of the circumstances where somebody never set up for financial planning. They never created a plan. They just set monies aside into their employer-sponsored plans like a 401k or they're getting a pension. So they'll go and they'll contact us when they're 55 or they're age 60, and they say, hey, I only have a couple of years left before I retire. How do I make sure to do this effectively? So we want to know what is your starting point and then what is your ultimate point B. So what is your point A and then what is your point B? What is your ideal retirement date? This could be 55, this could be 60, this could be 65, this could be 75. It really just depends on, what your specific situation is, how much you actually enjoy doing the work, for your occupation, whether you want to do that into some capacity as you are retired. Maybe you want to do it part-time because you do love the work that much, or if you're like majority of individuals, of Americans, they obviously want to try to, nip that in the bud as fast as possible and try to enjoy their lifestyle as much as possible. The third component that is a little bit morbid to speak about, but it's a very realistic truth, is what is your projected date of death? Now, whenever we put together plans and somebody says, well, I don't really know, I had my family members, my mom, my father passed away when they were both in their 50s of massive heart attacks. I've had, stents put in and I feel like I'm not going to last, past age 65. That might be a realistic truth to project a date of death, as, insane as that sounds. Or you might have an individual that says both parents live to age, 95, age 90, age 100, whatever that case is. But whenever we're dealing with certain plans, we like to make sure that we're projecting the person living to age 100. Reason being is because even if, let's say, they fall short and they're, pass away, unfortunately, at age, in their early 80s, early 90s, whatever that case might be, at least we plan for that long time horizon. The worst thing that somebody could do is plan to, let's say, live to age 75, and then all of a sudden they're age 74, and they only have a couple of dollars in their name because they've exhausted all their monies. They didn't do it properly. So, it's unfortunately a very realistic situation. So when we know this point A, what I like to use the verbiage of is say, okay, figure out what your point A is to what your ideal retirement date is point B, and then to DOD, to date of death. So that's what we'll try to help, figure that out based on, longevity, based on how long somebody in your family has lived to, if it was, some sort of natural death, how exactly does that work? And all it is just dividing what those months are. So if, let's say, we have, a time stamped on somebody's head and we say, okay, we're going to have them live to age 100. We have an individual that's age 50. They're looking to retire at age 65. Well, this tells us they have 15 years to accumulate further their dollars with their assets, so that how can we make sure that they do not outlive their monies from their age 65 until their age 100? Or if somebody wants to come to the table and say, I know unequivocally I'm not going to live till age 80, past age 80, well, then maybe age 65 to age 80 or age 60 to age 80, whatever that case might be. So, this is where we take the time and we try to really understand somebody's situation and say, okay, what's your current situation? What's your current income? Do you want to have that same sort of lifestyle throughout retirement? Are you going to have a decrease of expenses throughout retirement so you could still maintain your lifestyle? So what exactly does all those mathematical components come out to, so that we basically take the starting point, the middle point, and the ending point, and we divide it by each other to know, systematically how much you have to save, what would be a projected rate of return, or what sort of accounts can you leverage on a safe accumulation basis or an aggressive basis to get you to those specific nest eggs. So next bullet point, I talk about using tools or accounts to help accomplish your goals. And this is the most important thing that is overlooked time and time again. And what I mean by that is somebody will go and they'll see the nice shiny object. They'll see the market and they'll say, oh, the market's producing this 20%, 30% rate of return. I just have to go and dump all my money in the market and everything will work out and everything will be fine. I'm just going to listen to the talking heads of media and, that's going to be my plan. Well, be mindful how financial planning works. It goes by a wealth accumulation stage to a wealth preservation and distribution stage. So what I mean by wealth accumulation is how to make sure that you're effectively accumulating your wealth as large as possible. So if you're saving money, how are you using your employer sponsor plans effectively? How are you using your savings plans or your individual retirement accounts effectively? Does that mean that you're placing monies in savings, that you're putting money in non-qualified brokerage accounts, that you're purchasing real estate, that you're adding monies in your 401k accounts, that you're putting monies in Roth IRAs? How exactly can you make sure that you have all these individual buckets that are ultimately versing each other, so that when it comes time that you hit that ideal retirement stage, you no longer have to take on as much risk as trying to accumulate your dollars, but now you're trying to, the P is preserve your dollars and create a proper distribution strategy. So the largest mistake that's made is individuals using the wrong tool for a situation that does not accomplish that specific need. So like as an example, if you're trying to hammer in a nail into a wall, can you use the back of a screwdriver to do so? Yes. But would it be more effective to use a hammer? So that's the same sort of concept regarding financial planning and using the tools and the accounts with financial planning. There's an acronym that I like to use when somebody's set up in their wealth accumulation stage. It's known as TIME. The T in TIME stands for taxes. Does it make sense to be more tax effective, more tax efficient by the time that you start pulling out monies? Meaning, does it make more sense to take out dollars that are tax-free? As an example, if you're pulling out monies that are $90,000 tax-free versus a $100,000 account that's fully taxable, if you're in a 30% tax bracket, as an example, you're pulling out $100,000, you're only able to net $70,000. Versus the $90,000, which looked like a smaller number initially, you're able to net after your tax bracket $90,000. Because this is tax-free. This is more tax-effective strategy. So, where did those tools come into play? Does that mean leveraging cash value plans or leveraging Roth IRA accounts or Roth 401k accounts that are offered through your employer-sponsored plans? How do you know that if you're placing $1 aside, what sort of compound interest is that going to equate to later on? So that takes care of the T. The I is inflation. So rather than just taking your money and dumping it underneath your mattress each year, be mindful that there is something known as inflation, the cost of goods and services that keep increasing. And unfortunately, in this current economic environment, this is becoming a forefront off of you have a lot of dollars out there and you have a large demand for certain things. And so you have an increase of inflation that's running up on astronomical levels. So, inflation, does it make sense to just go and take your money, take $100,000 each year, just dump it underneath your mattress, or would that be a hindrance? The reason why that would be a hindrance is because if, let's say you have, rule of thumb is inflation increases by about 2 to 4% each year. So if you have inflation at a high end of, let's say, 4%, and you're getting a 0% rate of return on your money, you're losing to this invisible negative of minus 4% each year, because you have the cost of goods and services, the gallon of gas, the gallon of milk, price of a car, price of a house, bread, groceries, whatever that case is, the cost of goods and services are increasing. So rather than just throwing your monies aside, which is good to be systematic and to start saving, but you also want to make sure that you're effective. And an illustration that shows this point a little bit further is this account value formula. So if you're working for a company, and let's say they offer a 401k account, well, think of that 401k account like a bucket. The way on how this bucket grows is by the contributions that somebody's making into their bucket and then the rate of return that's coming back. So if, let's say, somebody has an employer-sponsored plan and they're offered a match, let's say they make $100,000 per year, and they're placing 5% of their monies into this account, which is $5,000 of their salary into their account, and they get a 3% match as an example. Well, if they make $100,000, they put $5,000 in there, they're going to get $3,000 of a match. So now you have $8,000 that's working on the contribution side. So that's obviously adding a positive into the bucket. Now, this rate of return, this could come back positive or it could come back negative based on the different investment performance that's linked to this bucket. So let's say if somebody's super aggressive and they're set up with different equities, different aggressive equities, and the markets do very well that year, and let's say it has a positive 20%, well, then that will be an additive into the bucket of, obviously the bucket's going to grow by that 20% number off of what the existing dollar amount was, plus the contribution, plus the rate of return. Now, the opposite side of the coin is what happens when somebody's nearing retirement. They're still aggressive, and then the market drops 20%. Well, it's equivalent to someone taking a sword and slicing that bucket. So it is good to have, a proper performance or a proper rate of return related strategy, but you want to make sure that you're not over leveraging the chips, especially as you start nearing your retirement stage. And a case in point would be, let's talk about an individual that tries to retire right around 2006, 2007, and then they experience that large 2008 market crash. That was obviously a problem. They experienced a negative, so they had something known as sequence of returns risk, which produced a large negative initially as they pulled monies from an account, as they were paying fees on that account. So you'd have power of compound interest that was working against this account, which liquidated those accounts very quickly. So that's something that obviously makes sense to avoid. But when you're in your accumulation stage, if let's say you're young and you have 15, 10, 20 years out from retirement, well, then you might be able to take those risks, take those ebbs and flows, because if the market should have some sort of upward trajectory, well, then maybe a loss might not be as impactful as a loss right before retirement. So be mindful of how this account value formula works, because it doesn't just work for 401k accounts or IRA accounts. It works for pretty much anything. So let's say instead of a 401k, I just said, okay, let's say you're going to put money underneath a mattress. So you're going to go and dump $10,000 per year underneath your mattress. Well, you added $10,000 that year. Because it's underneath your mattress, what's your rate of return? Well, 0%. So that just means the next year, if you had another 10,000, it's going to grow by 20. It's going to go to 20,000. Next year, it's going to go 30,000. So yes, you're going to have an accumulation. You're going to have savings. Kind of think of it like a piggy bank, above your refrigerator. Yes, that money's going to grow, but if you have that invisible negative of inflationary risk, that will obviously be these invisible negatives that will start to put pressure against this account, because when it comes time to actually start using these dollars and using it for the cost of goods and services for your to accomplish your expenses throughout retirement, that could obviously be a hindrance because you didn't allow it to grow. So understand T is taxes, I is inflation, and then you have M is market or market losses. So this is where sometimes it makes sense to leverage your dollars and go completely in the market. And then other times it makes sense to kind of splice it and verse accounts against each other. What I mean by that is you could leverage different indexing related strategies to say, okay, if I want to go or even diversification for that matter, a reason why diversification could be an effective strategy would be if somebody wants to be, very aggressive with the market and they want to leverage their dollars towards stocks, well, then a component to that, a counteract to that component could be bonds, or it could be, safe accumulation related accounts, such as fixed index annuities, market linked CDs, different notes, different things that you could do to say, okay, as the stock market is going to ebb and flow, maybe these other positions are going to have less correlation to that stock market, and that could give me a higher, rate of return, so a more consistent rate of return. So something that could avoid those negatives. Because it's good, obviously, to have growth, but when somebody sees those negatives hit their accounts and you have a downward market year, people panic, they freak out, they sell out their positions, they put their money in cash, and they basically sit on the sidelines and they're trying to time the market. Market timing, and there's different data out there. One important tool that somebody could always research is something known as the Dalbar study, that it shows that market timing just simply doesn't work, and individuals invest with their emotions, and basically behavioral finance is a large component of why individuals miss out on opportunities of large market gains rather than staying invested or staying consistent with a plan. So that's something that you'd want to avoid. And then the last E would stand for expenses. And this is just, pretty common knowledge. If you're going and let's say you're paying 1.5% towards mutual fund related expenses, and then you're also paying an advisor 1.5% for an advisory fee, this is minus 3% that's already coming out of your bucket. That's a negative that regardless, before the market actually does anything, before your accounts do anything, you have a minus 3% that's hindering your account. So even if your growth gains 4% as an example, you're only netting 1%. If let's say it gains 10%, you're only netting 7%. If let's say it loses 10%, well, you're really losing 13%. So you want to make sure that you're reducing those expenses and you're only leveraging the necessary expenses possible. So this is why Jack Bogle, we have Vanguard funds. He created ETFs and index funds and different things to help reduce what those expenses are, with different indexing related strategies, or you could leverage no load mutual funds, different things that could reduce those costs and reduce that pressure against your accounts effectively. So now I'm going to focus into some of the more common mistakes, which I've already touched up on, but it's trying to use a jack of all trades strategy. So what I mean by this, and this is very typical with individuals, let's say when somebody starts working, they're in their 20s, they're in their 30s, what are they doing? They're placing money aside. Typically it's with an employer-sponsored plan. They're adding contributions into there. They're getting a match, and we know that the other component is rate of return. So what do they do with this rate of return? They're trying to just set it and forget it. Put monies aside, have it super aggressive, and try to make sure that this is growing as large as possible. So you have the combination of the contributions, and the rate of return, which is equaling how large that, the size of that bucket is. When we fast forward and then we get to a wealth preservation distribution strategy, does it make sense to still use those investments or still use that accumulation strategy? And the answer is no. Typically, when somebody understands what their current situation is regarding what their budgeting analysis is, how much that there will have of some sort of guaranteed cash flow, maybe through that's a pension plan or that's through Social Security income, versus what their actual expenses will be, they're going to see that gap there. So if you try to leverage investments for a income and distribution related strategy, that's where individuals could burn through their accounts and burn through their money very quickly. And there's different withdrawal strategies. When somebody wants to utilize investments for an income-related play, you have something known as the 4% rule that came out in the early 2000s, which has essentially been debunked. And there's different publications that are constantly coming out saying that rather than pulling out 4% of your monies each year to accomplish your retirement income goal, that's actually going to be reduced down to 2.8%, 3.2%, 3.5%. So there's different leading publications that will basically show that data on how that's a risk if somebody's trying to just use that 4% for a specific cash flow to pull out their monies. So then it comes to the conversation of what's the purpose of your financial planner? What's the purpose of investing? Are you just trying to grow a fat account, as fat as possible, and just have all these millions of dollars or hundreds of thousands of dollars sitting there, and then you're still going to be panicking because you're leaving those portions in investments? Or do you want to actually have a strategy in place that says, okay, out of my $1 million that I've saved for retirement, I understand that I need to leverage $300,000 towards a type of income-related strategy, maybe leverage $100,000 towards an emergency-related strategy in case of an oh my gosh moment that occurs, and now I have $600,000 remaining that I could leave towards those investments, towards that growth-related strategy or towards a safe accumulation strategy, whatever that individual's mindset is. So this is where, from an income distribution play, that you could use this. This could be accomplished through one account, or it could be accomplished through 5 different accounts that are laddered properly. The emergency strategy, this is more towards a savings, a money market account, and then this $600,000, the discretionary monies, this more a growth/inflationary protection dollar amount, that could be utilized towards 6 to 10 different accounts, towards one different account. It really just depends on what this person is looking to do from their financial planning aspect. But you do not have to be handcuffed to just say, okay, I've been aggressive this entire time through my working career. I just want to stay aggressive with that same sort of strategy, because that's not a strategy. That's not a plan. That's hopium. That's hoping that the markets are going to stay favorable and hoping that you're not going to outlive your monies. Well, if you fast forward in the future, and let's say you retired at age 65, and now you're in your 70s, and you've unfortunately drained down your accounts because you got hit with reverse dollar cost averaging, that's obviously a problem. That means you either A, have to go back to work, or B, have to rely on your kids or your family members to help keep you afloat, or C, just completely downsize everything and just rely on Social Security income as your only, solid cash flow. So this is something that we see time and time again. It doesn't matter. We could have the person that has $3 million of accumulated assets, and I've seen those individuals blow through their monies, as opposed to the individual that comes to the table with 300, 500,000, and they've set up their plans effectively, and they made sure they had, the correct measurements, and they have hundreds of thousands of dollars left over because they spliced it up properly. So all because you have, what is exactly your plan? Is it to have that large nest egg, or is it to make sure that you're accomplishing your goals throughout retirement? And that's where it really comes down to discipline. So discipline based on what your starting point is, your point A, discipline to point B. So how to make sure that, you're constantly checking and double checking and triple checking, okay, does this ideal retirement age, has anything changed? Do we want to make adjustments? Do you want to add more dollars towards savings, less dollars towards savings? What sort of accounts do you want to make sure are growing to try to accumulate your dollars properly to get to this point B, so that from point B until date of death, there is an effective income distribution related strategy in there that you can still have excess monies left over. So the number one thing is being disciplined. And the mistakes that we see constantly are individuals that just try to get rich quick. They just try to time out the market. I want to dump all my money in cryptocurrencies, or dump all my money in the market, just be super aggressive and not care about anything. It's basically taking a measured approach. It's really the tortoise and the hare type situation. The tortoise, slow, systematic, methodical. The hare are kind of all over the place, running all over the place. The tortoise will win at the end. And it's just making sure that you're avoiding the negatives, that you're getting the power of compound interest to work in your favor, and you're creating a proper strategy that will accomplish your needs. These other components are something that I already touched up on: accumulation strategy versus distribution strategy, understand what the difference is there, income versus emergency versus growth. So like I mentioned before, does it make sense to leverage an income-related strategy if you have a growth-related need? And the answer is no, just like it doesn't make sense to leverage a growth-related account for an income-related strategy. Like I mentioned before with that 4% rule, individuals that try to tie their money to investments and they're trying to utilize that 4% rule, why would they do that when they could use a different tool, such as an annuity, that will produce a higher cash flow? So like as an example, let's say somebody's age 60 and they have $1 million of retirement assets and they want to retire at age 65, and their goal to retire is, let's say they need $60,000 of income, and they understand at age 65 they're going to be getting $30,000 of Social Security income. Well, with this, by leveraging the proper retirement income distribution, either strategy or account, we know that they have a gap of $30,000 there. So with their income plan, out of their $1 million account, that would make more sense to use, let's say, $300,000 to produce it to the correct product that will give them the $30,000 of cash flow. So they're only using $300,000 to place into that product, versus utilizing, if we're using the 4% rule, you just take 4% and you divide it by 30,000. That would equal $750,000 that you would have to use towards some sort of retirement distribution strategy, and that is still not guaranteed because, like I mentioned before, that 4% rule has actually been debunked. So, why would you use more chips if you don't have to? Because in this scenario, if you leverage your income distribution strategy properly, it only costs you $300,000 out of your $1 million. Now you have $700,000 left over for your emergency need and for your growth/inflationary need to have fun with. So you could take on more risk. You could invest in those company stocks that, you purchase products on, like Apple or Tesla or whatever that case might be. So you don't have to, utilize as much risk, and you could have more of an enjoyable time throughout retirement. And it's all about creating that sort of safety net. So if you know that there's a minimum cash flow that's coming to you every month between the combination of Social Security income, of pension income, of annuity income, different things that will create a maximum income or distribution related strategy, this will leave all these excess monies, at your fingertips to really go and use as splurge accounts and have fun with it. So I've obviously spoken about the, how does financial planning work from the 30,000 foot view? What are some common mistakes? Now, what are some solutions? And this is something that we touch up on. We have a trademark process known as the retirement diet plan. So obviously feel free to give our 1-800 number a call. It's 1-800-566-1002 and ask to speak to a specialist. We do have some minimum requirements for individuals that are calling in based on, the amount of assets, based on what your goals are, and seeing if we can help your specific situation. But a simplistic takeaway would be leveraging a 3-thing scenario. And there's 3 things that every individual needs to figure out before they're retired, or if they're currently retired, and how to stay retired forever. The number one step is income. The number two step is emergency. And then the number three step is growth/inflation. So if we have a situation where somebody is age 60, they have $1 million of retirement assets, they want to retire at age 65, we know that at age 65 they have Social Security income that's coming to them of $30,000. They have a pension income that's coming to them of $30,000. But after doing their budgeting analysis, where we go over a 3-page budgeting sheet to understand every nook and cranny of what your expenses are today and then what your expenses are going to be at age 65. Let's say with this individual situation, we uncover that he has $80,000 of expenses at that point. So we know between the two of these, this is going to bring $60,000. The expenses are $80,000. So what is the gap? What is the goal that we have to accomplish with the step one? And the gap is $20,000. So if we have $100,000, think of it as a bucket or multiple buckets. How do we make sure to leverage this effectively? So using the smallest amount of dollars only as much as necessary in step one, so you can have as much leftover monies for step two and step three. So maybe out of this $1 million, it's going to cost $200,000 to go into step one that they could utilize towards an income distribution strategy. Because of their expenses being $80,000, rule of thumb is for emergency needs, an individual should have anywhere between 6 to 12 months of what their annual expenses are, or what their expenses are, into some sort of liquid account. So maybe that means leaving monies in a checking or a savings account. So out of this $200,000, this could accomplish step number one out of the $1 million. Maybe in step number two, that's only going to require $50,000 to accomplish step two. And now what happened? Now we have as much fund money left over in step three for that growth/inflationary need, and we have over $700,000 or $750,000 remaining. So this is where, everything gets fun at this point. So what is your ideal retirement situation? What do you want to do in retirement? Does that mean you want to travel the world? Do you want to visit grandkids? Do you want to just be able to buy presents, to donate to charities, donate to your church? What is something that gets you excited for retirement? Not just sitting on your couch and the highlight of your week is bringing in the garbage cans. So that's where I try to also explain to you what sort of vision, and try to pull out that vision from your mindset to make sure that how can this actually become a reality with your specific plan. So with this, out of the $750,000, some individuals are more risk averse, and this is where risk capacity comes into play. So it's not so much risk tolerance is something that's more short-sighted. So that's sort of individuals that's trying to figure out, okay, is the market going to be good to me? This is what I'm going to be terrified that the market's going to go down, or I'm excited the market's going to be going up. So this is where we use some artificial intelligence software to help pinpoint what exactly is your risk score, to understand what your risk capacity is. And like something in this sort of situation where an individual has $750,000 of excess monies of remaining dollars, this risk score could be significantly higher than, let's say, somebody that only has $50,000 of remaining dollars, because maybe they want to try to stretch this dollar out further. So what risk score does is it's going to help an individual understand what they feel about the market, and then how to make sure to splice this out accordingly. So maybe out of the $750,000, they want to be super aggressive with $500,000 of these monies. Maybe $200,000 of these dollars, they want to be super conservative into some sort of fixed account, and maybe $50,000 they want to leverage, to some sort of safe accumulation related strategy, where there's a whole different way on how you could splice out that pie. Maybe they want to use all the monies towards investments and just really go gung-ho in the market and say, okay, well, I want to leave these monies aside because I want to leave some sort of inheritance, and I want this inheritance account to be, part of something that's tied to the market, or, tied to some sort of real estate, related goal. So there's a whole multitude of different things. It's just making sure that you have those safety nets, so that you always have the cash flow is going to be king when it comes time for retirement. Making sure that you have your proper distribution, proper cash flow related strategies, so that you do not have to panic every month. You know that those retirement checks are coming in, and that will at least hit your minimum requirements of your expenses each month. Whatever you want to use for risk, well, then we make sure that it's measured properly. We're not just guessing and saying, okay, like you have these different criteria out there. Like you have these different rules. It says rule of 100. If, let's say, somebody's 60 years old, that means that 60% of their monies should be going into some sort of fixed or conservative related investments, and then 40% could be invested aggressively. Well, if somebody is age 60 and they have more of a bullish mindset off the market, they shouldn't be handcuffed to this, rule of 100 type situation. They should be pinpointed to exactly what their risk capacity is, what their risk score is, and make sure that that is spliced, correctly. Lastly, and really most importantly, is taxes. What I touched up on before is, do you want something that's going to be fully taxable? Is that going to hinder the amount of Social Security income that you'll be able to receive? Because if you're taking all monies from taxable accounts, pre-tax qualified related accounts, that could also increase your income, or the taxation on your Social Security income, and that could make you net less dollars in your pocket because you have obviously more dollars going to taxes. So, like as an example, if you're pulling out $100,000 of retirement income, but you're getting dinged with 30% worth of taxes, well, then that's only realistically $70,000 that's coming to you, because $30,000 has to go to the government. For something that if you can mix and match and make sure that you're setting aside accounts and you're doing proper conversion-related strategies, well, then maybe out of this $100,000, you're able to net $90,000 or $80,000 that will accomplish what your specific need is. So I'm just using generic concepts with it, but I want you to see the importance of these things, because obviously these little slight tweaks can make a large mathematical difference throughout retirement. And that's essentially it. Once again, if you found value in this video, if you'd like to speak to a specialist, simply give our 1-800 number a call. It's 1-800-566-1002. We're available 24 hours a day, 7 days a week. You could also visit our website, which is retiresharp.com or fosseyfinancial.com. So you could navigate around, you could download different reports, you could see our other videos, you could review what the retirement diet plan is. You could also do a live chat with us over here by clicking on that right-hand side and speak to a rep. But most importantly, it's really whatever your schedule pertains to and really whatever you want to see. The large mistakes that are made really comes down to leveraging the proper tools and lack of discipline. So like as an example, you'll have some insurance-related advisors, more conservative-related advisors, that they'll say, place everything into an annuity, place everything into cash value life insurance. And that might not pertain to your specific situation. If somebody has a more aggressive mindset, well, then they might absolutely love investments, and they might like the thrill of the stock market and utilizing that. And that should be setting up a plan specific to each individual's needs and each individual situation, and vice versa. If, let's say, somebody thinks I only have to place my money towards investments and I can only use the stock market and I only use a combination of stocks and bonds to get to my goal successfully, and that's where you have some advisors that are more towards that wealth accumulation side, and they're more towards tacking on a management fee to just try to grow those accounts and make sure that there's a constant residual fee coming out, for their benefit. That's obviously a problem. So you have to see what is going to be the perfect mix. When does it come time that you should be utilizing some tax-effective strategies, some income-efficient strategies, such as an annuity or safe accumulation strategy through like a fixed index annuity, versus using the monies, the leftover monies or dollars towards a growth-related strategy. So, one side really isn't more correct than the other. It really is determined by the individual's mindset, and different things like understanding what somebody's risk score is, what their educational process is regarding, their financial planning side, what they've been accustomed to, and then making sure that they're being educated, moving forward. So, once again, if you did find value in this, what we try to do is take a non-biased approach and look at the 30,000-foot view, look at what your point A is, what your point B is projected to be, and then your date of death, and then how to make sure that you're actually building out a plan. And this is something that we do with that retirement diet plan. The D stands for distribution/income planning. The I stands for investment/growth planning. The E stands for estate planning or legacy planning. And the T stands for tax planning. We want to make sure that all those different quadrants are met so that you actually have a plan. You don't just have a portfolio. You just have something that if the market craps out or something's too conservative that's not giving you a higher enough rate of return, that's not going to accomplish your goals, that's obviously a bad situation. So once again, you found value in this, please feel free to give us a call. If not, make sure to subscribe to our YouTube channel, Retire Sharp, so you got to have access to the most updated videos. Thanks so much, guys.